So can we go through a case study together?
Yeah, absolutely.
Great.
Okay, so this is a property, and I actually have the address here. So it's 18915 East 16th Place in Aurora, Colorado. So it's a property that a client of mine bought. So let's just talk about it. We bought it for $95,000. It's actually an attached property. So it's on a cul-de-sac, and it looks like it would be single-family homes. It just so happens that the homes are attached. 2 homes are attached.
So let me stop you there. I just want clarification. So this is a duplex.
It's a duplex, but they look like single-family homes, but they are literally attached.
So did your client purchase both?
Nope.
Okay.
Just one. So he bought essentially half a duplex, and that's just what it is.
Great.
Yeah. So, and by the way, we bought this because, and let me tell you why we like a property like this. Because we can buy it cheaper, a lot cheaper than a single-family home. Because just think about it. Would you pay more for a home that's attached or unattached? Obviously, you're going to pay more for an attached home. But tenants don't really think that way. This is an important subtlety. Tenants are there for a year or 2 years or 3 years. So they don't say to themselves, I'm not going to buy this because it's attached to another property. So if you do the math in your head, what happens is we can buy it for a lower price, but still get the higher rent. That's how you get cash flow. Just one of a million little tricks that we employ.
Beautiful. So what about the property?
Okay, so it was 4 bedrooms, 3 baths, 1,267 square feet. It was actually a 2-story, and it had a basement in addition, 1-car garage, which you see on the right there. It's a lower middle class area. I would definitely say it is not middle class. I and my clients happen to like that demographic, the middle to generally lower middle class neighborhood. This is a very typical property that we would buy. This is one of the many things that you're going to have to think about. You might say, no, Charles, I want more cash flow. Great, you're going to go to a lower end neighborhood. You might say, Charles, I want to make sure that it's safe and that I want to be comfortable there. You're probably then going to move up to a middle class neighborhood. What I'm going to tell you is there is no absolute answer. You read lots of books and the books say, you have to buy in this type of neighborhood. You have to buy in that type of neighborhood. That's because they have to sell books and they have to pretend they know what they're talking about. My experience is a lot of it depends upon where you want to do business. This happens to be a lower middle class neighborhood.
Let's take a look at the pro forma.
Great. Yeah, let's go through this. Let me walk through the numbers.
Okay. We're going to try and go through this quickly, Charles, but I do also want to make sure that the listener is clear that you've agreed to offer this tool as one of the parting gifts at the end of today's class.
Yeah, absolutely.
Okay.
It's an Excel spreadsheet. It's really simple. You just type in the inputs and then you click on the next screen and it'll tell you something about your purchase.
Okay, so let's go through this real quickly. So we've got the property address here that we just addressed. Its number of units is only 1. Purchase price that we saw on the last slide. $5,000 rehab costs were put in?
Yeah, it was kind of a paint and carpet sort of thing. It was about $5,000 paint carpet, and that was about it.
Yeah. So a little lipstick, and you can see there instant equity.
Yeah, he had some equity, but he's not going to sell it. I mean, this guy's holding these forever. So is that after repair value really $115, $125, $130? Frankly, I don't know because we wouldn't know until we sold it. But the fact is, we don't really care because what we care about is his monthly cash flow.
So mortgage interest, 4.75 over 30 years.
Yep.
20% down payment.
Yes.
And that down payment, keep in mind, folks, that if you actually are executing the techniques that we teach in the 100% Debt-Free for Life class, you don't necessarily have to have 20% in your back pocket to put down. You can actually get that down payment from other sources, put less than 20% down, but the actual first mortgage requires that down payment and would be an 80%, maybe even 75% loan to value.
Yeah, you'll get a slightly better rate at 75, and that's a point I want to make here. Back in 03, 04, 05, 06, we were buying these things for non-owner occupieds for 5% down. The fact is that doesn't exist anymore. And that is definitely going to be an issue for some people because if you don't have some cash, if you have no assets, you're going to probably need to build up these down payments. Right now, for a normal conventional loan, the minimum is 20% down.
And this is an argument that Charles and I have had on multiple occasions when we're presenting classes together, where I argue that if you got access to cash from a debt weapon and used it as a down payment, technically speaking, if you obtained 15% of your down payment from that debt weapon, or even the full 20 or 25% that you need to put down from that debt weapon, technically speaking, it's still a 100% combined loan to value financed property.
Right.
It's not cash you had in a checking or savings account per se. So there are additionally creative ways to get in for less out of pocket. And we do have a little to no money down investing class that we did with a mutual friend of Charles and mine. But keep in mind that Charles is the ultra conservative educator, which I really like about him. I too like the ultra conservative approach. However, we can't ignore the fact that there are still creative ways to get into a property with less out of your own pocket.
And I've seen them done, and some of my clients have done them. So you're absolutely right.
Okay, so as we go forward on this pro forma, we've got a unit number 1 at $1,250, and the reason that these others aren't filled in is because it was a 1-unit property, even though they bought half a duplex. Okay. Vacancy factor, you already account for that. That's great.
Yeah, I put in 5%. Right now, it literally is 2% in our market. Put in anything you want. You want to be more conservative, call it 8%.
And then I see here on the operating expenses, you break these out annually, which is good. You've got the taxes, insurance, as well as the maintenance factored in already.
Yeah, we figured $750. Obviously, we don't really know. Maybe the person will stay for 2 years and it's nothing. Maybe they'll leave in a year and we have to paint or something like that. Okay. $750 is about right for a property like this.
Okay, so when we flip over to the next tab, which just so you're aware here on the bottom of the page, there's 2 pages here that you will have access to when we provide you the gift of this spreadsheet. You can see that some of this data has transferred over onto this other page, but you can see here the down payment ended up being $19,000.
That's right.
That was the 20%. And then the loan costs, $36.25.
Yep. So he just got a normal conventional loan. That's what it cost him. I just pulled it off what they call the HUD-1, which tells us what he paid.
So the total investment here was the $27,625?
Yes.
Okay.
Yeah.
And then the rental income ended up being about $15,000 a year.
That's right.
So that netted out $14,250 after you factor in the 5% vacancy, which was conservatively rounded up.
That's right. Yes.
Okay. So let's look at the other expenses that you had accounted for on the previous page. Total of $1,987 annually for a net operating income of $12,283 or $263 rather.
Yes.
Okay. So how does this all work out in the end?
Okay, so here we get some numbers right here. And this is where you have to decide how much you want to get into this. There are lots of different metrics you can use. There's cash on cash. There's 5-year return after taxes. There's cap rate. There's the net operating income. There's so many different ways to do it. We choose a couple right here so that we can basically compare this property to the next property we look at. So the first time you look at it, well, you're not going to really think too much about it. We're going to talk about it. But what's going to happen is after you've looked at 10, 50, 100, you're going to say, this 101st one is the best one I've seen. And that's where it's really going to get relevant. So what we have here, for example, on line 43 is the annual cash flow before taxes.
And if you can't see 43 here because it's slightly cut off, annual cash flow before taxes, $7,500.
So the cash on cash rate of return, that's a really important one. So let's say you take $1,000 and you buy a bond and you get 1% interest rate, which is about what you're getting. The cash on cash rate of return for that bond is 1%. Here, the cash on cash rate of return, given all of the elements we put into this, is 27.2%. That's why we're talking about this.
And that's taking the annual cash flow before taxes and dividing it by the total amount invested.
That's correct.
And that's where you come up with the 27.2%.
That's right.
So in theory, going back to what I was saying earlier, if hypothetically a student were to obtain a debt weapon in the form of another tool where they had access to capital, they used that money as their down payment, but it was not sourced from their back pocket, that would mean they had less of their own money into the property, which would mean that this number would reduce. However, this number would probably be reduced slightly because they may have additional liability, right, where they have to service more.
Right.
But perhaps this number could increase because they have less money out of their own pocket. Is that right?
That's right. So I want to make you understand this is a fairly normal deal where I work in Denver, Colorado. And this is probably going to be what the numbers look like at the end of the year. There is nothing speculative about this. And let me just show this one more time. You took $27,625, you bought a property, you fixed it up, and you got the loan. In the first year, you're going to make something like $7,506. The return is simple division. It's 27%. This is why you think about maybe doing this. There's some work, there's some risk, there's some effort, but you're not getting 1%. You're getting 27 times that. And by the way, have you heard me say anything about appreciation? This is not including appreciation.
Or depreciation.
Or depreciation. And that's very important, because I'm not going to sit here and speculate that this property is going to go up 3%, 6%, or 10%. Now, I will tell you, right now in my market, this neighborhood has gone up 11% in the trailing 12 months. That's just what's happened. But we don't even include that. The best number you can use is about 6% appreciation over the long term. So that would be 6% of 95,000, which would be another 5,000. So if you care to do that on your own, that's great. I'm not here trying to lead you down a path. I'm just telling you, without appreciation, this is about what you'll make in the first year.